Hello and welcome back guys to the channel, right? And on today's video, we are basically going to be talking about sniper entries. Now, before we get into it, make sure you subscribe if you haven't, turned that bell button on for notifications, and let's get into it, right? Uh, when talking about sniper entries, right? Sniper entries are often a development of an in-depth understanding of what you're doing in this forex markets. Now, however, we as MMC footprint traders, um, our understanding of the forex markets comes from three most important things, right? Which are structure, S&D, right, and comfort, right? So this is the whole root of the MMC footprint strategy. Now, however, this new trick that I'm going to teach you guys on how to, catch sniper entries in the forex markets is actually going to come from these two most important things right here, which is structure and S&D zones, right? Now, let's see at a little insight of what we're going to be seeking to see in these charts, right? So our whole entry criteria is based up of the following schematic, right? So first example in a bullish trend, right? We need to have an up move like that, a little pullback, and then a continuation, right? To indicate what there's a break of structure, right? So this break of structure right here validates our first S, which is structure. And once we have that, then we're going to seek for another S, which is S&D zone, right? So in this case, we're actually going to look for that, down the last down move before the up move started, which is also what the demand zone, right? And from the demand zone now, we're going to actually seek that pullback, through the intermediary trend, that pullback in which price is going to come here, mitigate this S&D zone, and then from here, continue now to its trend, which is the bullish trend, and come to take out this high as its next liquidity run. Now, from that understanding, right, why does this happen, right? Why does this happen, right? This happens how? Um, we know that, as smart money traders, we know that the composite man or smart money are the ones who actually make, the moves of the markets. With that being said, that means that, if smart money took price high, created this high, then this low, and then this high, mean, what kind of mechanism was used here, right? So from this high to this low, right, it means that they sold, right? And when they reached some point here, they sold this very hard, right? And bought it very hard, very hard, right? To make this high in such a way that, we know that they sold here. If they sold and then they bought very hard, means that there are some of their orders weren't closed. And if those orders weren't closed, then we know that, that smart money uses millions and millions and millions of lots, means that these orders are running in very deep negative losses, in which smart money doesn't take any losses, because, the composite man is always profitable. So what we need to understand is that these orders are, one way or another going to be closed at either break even or with a very little loss. And that is where the whole idea and the whole, scenario of mitigation comes into place, right? So mitigation is simply a move by smart money, to take price from where it is to where they want it to go, to do a certain thing, and then repel from there to continue with its true trend. Meaning what? From this high here, right, smart money are going to sell this thing, right? Smart money are going to sell this thing from all the way here up to here. To do what? To mitigate their orders, right? Mitigation of the orders, meaning that they're going to take price right back to the orders, their negative orders, in order to close these negative orders, right, at either break even or a very little loss or a very little profit. And then now from here, once they have secured their money, they can now release price, with an absurd momentum to continue now to its right or true trend. Thus, this is just another way to engineer and take liquidity over time. Why? Because when they bought here, right, when they bought here very hard, they engineered liquidity, right? And from this high, when they sold, they also engineered liquidity. Now, the dumb traders, often called dumb money, traders who actually sold from this area and are looking to hold this price to either come, like break this low and continue even more bearish. These traders are going to be trapped as liquidity. Why? Because smart money are simply gonna come and mitigate these orders here. Once this mitigation is done, price is gonna come up and take this high as its next liquidity run, in which people who sold here have their stop losses above too, right? So I hope that that scenario engineered some sort of knowledge into your heads, guys. So because we are looking to develop and take this industry to another level through the SMC and the MMC concepts. Now, um the actual basic trick that we're actually gonna learn today is how to properly refine these S&D zones in order to catch what sniper entries, right? And our refinement is actually gonna be a very simple one, right? Because more often than not, right? Because this has been tested and proved, right? Because if you have an up move like this and you have an S&D zone, right? Price will most likely than not, come here and then do this, right? And then do that. Now, with this scenario happen, right? We're actually from this area, we're actually gonna be taking the 50% of this, right? Boom. And the 50% of that is a level that, more often than not, price is basically gonna come to, right? And then leave from that area without confirmation, right? And this entry model is so far called the risk entry model approach. Why? Because it's a risk entry because we do not have the confirmation part in here. Now, if you want to add the confirmation to those things, you're basically most likely to miss out on a sniper entry, right? So everything comes with a cost, guys, and that is the cost of sniper entries. You want a sniper entry, you're not going to have a confirmation. You want a confirmation, you may not have a sniper entry. So that's basically up to you guys to be of choice. Now let's go into the market and see what exactly have we been speaking about. So I'm looking to clear these things out before we continue. So boom, we are all set and done. So for example, so we are on the gold chart, right, on the far, and from here we do have a very good example, right? So we did have in through following okay, so through following institutional order flow, right, we had something like this. So per se, from this high to the low, the high, the low, the high, the low, the high, the low, right? So when we were at this stage, right? So as you can see, guys, so from this area here, what we had was basically this downtrend, right? As you can see, featured with these multiple breaks of structure, right? So break, retest, continuation, right? Same thing that we were anticipating right here, right? Since we had this break, we anticipate that price could come back here, the S&D zone, which was most likely to be mitigated, and then continue down with this low as its next liquidity run, which wasn't exactly 100% what happened, but we are still in this bearish range. And of course we had tremendous very good sells in here, like we had a bunch of sells in here that were actually very profitable, right? Although our overall take profit target wasn't hit, but I'm basically a day trader, so I was looking to position myself in here as many times as I could and as much as possible to take the most out of this this whole down range. But it is what it is. So let's actually see how our our sniper entry schematic could have been. So we had a high and a low, and from that we had an S&D zone right here. So let's now come to this S&D zone and actually see how the 50% of it could have benefited us towards this this sniper entry. So boom, there it was. Let's just put a horizontal ray there at the 50%. As you can see, let's now remove the bib thing and these brush lines, and then let's have our our short position there. So everything, yeah, so this could have been our 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 sniper entry schematic, right? Boom. So something like this. So as you can see, right, the sniper entries are usually featured with very minimal stop losses. So this could have been a 1 to 19 RR trade, so which is actually it's a tremendous trade, right? So you know, if you're pursuing a funded account of 100K, so this could have been an easy 19K, $19,000, you know, as good as they come, right? As good as they come. So as you can see from this area, so let's zoom in and see the actual price, right? So from this, as you can see the line, so let's just put this short position in accordance to the line. So as you can see, price just leaves wicks from there, very minimal drawdown, and you know, it's actually tremendous, guys. It's actually tremendous. So this is how we catch sniper entries. So this is the little trick, this is the little secret that I was looking forward to share with you guys. So let's look at one more example at DXY before we can now, you know, actually proceed to other areas. All right, so boom. So what we had was this, we had this intermediary downtrend in here, which actually resulted into an overall, you know, downtrend for quite a while without, so prior, I was actually looking at this breaker structure, this demand, which gave us very good buys from here. But, you know, as you can see, price didn't reach our take profit target right here, and instead price just came and left these wicks, or other people could call them double tops or something, and then you know, break off from there to continue even more bearish, right? And you know, but it is what it is, right? It is what it is, because I believe I have talked about this price when, you know, like you can have something like this, and then price will definitely come back to S&D zone. I mean, S&D zone like this, you know, for that mitigation. And once that mitigation is done, price can now go up, you know, just like hit another, you know, stronger supply from here, and then change its whole trend. That happens. And as you can see, this right here is exactly what happened in this DXY chart right here, because price, what price did is that price came, you know, mitigated this demand and then came higher, and then you know, hit a much stronger supply, which then in turn resulted into this change of character and the absolute change of the trend. But you know, that isn't much of a concern, so let's just see how we could have caught um, this entry, right? So as you can see, right, we had S&D zone, we had these two S&D zones, right? So we had S&D zone 1 and S&D zone 2.0, right, which in turn we use them as one, and from this you can now stick out your fib like that, and then place this on this horizontal line at the 50% to indicate that's your entry mark. And from that entry mark, you're actually gonna have you know, if you're the one to use limit orders, then you know, you could just have your sell limit from there, your stop loss above the zone, and of course you are looking to target the low. So as you can see, right, so this is the beauty of the MMC footprint strategies, right? And as transparent as I am, I like to show you guys the whole thing, right? If it works, it works. If it doesn't, it doesn't, right? You know, there's no strategy in this world that's 100% accurate, right? And that's why not everyone is a trader, right? Because of some things like this. You're gonna have trades that work, you're gonna have trades that don't work, but you know, you had the same entry criteria, you follow the same rules, and you know, it is what it is, right? So risk management is above everything else. Now, you know, with that being said, guys, I hope you enjoyed the video, and if you did, then you know, don't forget to leave a like, subscribe if you haven't, turn that bell button on for future notifications, and you know, until the next time, guys, stay safe, have a nice trading week, and of course, peace out.